understand what is exactly going on in a stock. So just like doctors, they use X-ray to find out what is going on inside a patient's body. Similarly, investors also use charts to interpret the price and volume patterns found on the stock charts. When you use daily and the weekly charts, you could actually be using both the charts, daily and the weekly charts. The weekly chart helps you to see the longer term trends, and the daily charts help you to spot specific buy and sell signals on any given day. This is the second. Only a part of the story. To get the full picture, you also need to check about the volumes. So the reason is simple. You can't tell how meaningful a price gain was or a price drop was until you see how much volume was behind it. So it is like being told over the phone that your kitchen pipe is leaking. So you'll immediately want to know what is the size of the hole, if it's a little trickle or it is flooding. So in other words, you check the volume of water that is coming through that leak to gauge how serious it is. Similarly with your stocks, checking the related trading volume is the only way you can get an accurate picture on what is actually happening in the stock story. So we should use both the daily and weekly charts, and we, in the subsequent slides, will take you through both of them on how to read it. Okay, so this is the daily chart that we are seeing. So we're going to discuss both the types of charts, which is the daily chart and the weekly chart. So first, let's have a look at the daily chart. So when we talk about a daily chart, the bars that we see here, this is the price. These are all the prices that we see in bars. So if it's a daily chart, one bar would represent 1 day, and if it's a weekly chart, one bar would be representing 1 week. So this is a daily chart, so one bar would be representing 1 day. Now you'll be seeing there are few blue days and few red days. So whenever a stock closes in positive, it's going to be represented by a blue bar. And whenever a stock is closing in negative, it's going to be showing you a red bar. So this is how a stock performed during 1 day. So this is the high of the stock, this is the close of the stock, and this is how the stock closed for any given day. So this is all about prices. Now coming on to the very important part is the volumes. So one bar here again would represent 1 day, and a weekly chart, one bar would represent 1 week. So this bar represents how a stock traded, what were the volumes for any given day. So the higher the bar, the higher were the volumes. Now this horizontal line that you see here, this is the average volume over the last 50 days. So this is about price, this is about volumes. Now let's talk about these 3 lines that you see here. So this line, which closely follows the movement of the stock, is the 50-day moving average line. The other line that you see, which is more smoothened out, that is the 200-day moving average line. And this third line that you see, this is the relative strength line, which compares your stock performance vis-a-vis the BSE 500 index. So this is all about the daily chart, understanding how to understand this. And this is about the weekly chart. This is how a weekly chart would look like, and one bar would be representing 1 week here. So this is how a stock performed during 1 week. This was the high of the stock, this was the low of the stock, and this is how the stock closed for any given week. Again, a blue bar would be representing that the stock closed in positive, and the red bar would be representing that the stock has closed in negative. So this is all about pricing. Again, coming on to the volume bar, one bar is representing 1 week here, and this line that you see, horizontal line, this is the weekly average volume over the last 10 weeks. Now this line that you see, that is closely actually performing the measuring the stock performance, moving in line with the stock performance. That is the 10-week moving average line, which is same as 50-day moving average line. And the other line that you see, which is a more smoothened out line, that is 40-week moving average line, or same as 200-day moving average line. Now again, this is the relative strength line, which measures your stock performance vis-a-vis the BSE 500 index over the past 52 weeks. So this is all about the daily charts and weekly charts. Guys, do you have any questions in this up till now?
Hi, what do you mean when you say that relative strength of the stock? It's a single line, so how is it compared with the 500 moving, 500, the index?
Okay, let's say your index closed at a gain of, let's say, 0.5% and your stock has gained more than 5%. So this relative price length would be facing upwards. And let's say if it fared below 5%, let's say it closed in 0.2% of gain, so it will be actually facing downwards. So this is calculated over over 52 weeks performance. So whether your stock is outperforming the benchmark or it is underperforming the benchmark, that is shown reflected by this line. So whenever you see an upward journey, that's a very positive sign, and whenever you see this downward journey, that means your stock is underperforming the index.
Okay, thank you.
You're welcome. Any other questions? Okay, so we'll move ahead with our discussion.
Okay, we talked about basic chart reading, how to know what is price, how to know what is volume. We'll look at what to look for when we read a chart. In the most basic things that we look for in any general chart, what we like to see is price in conjunction with volume. So we want to see when the stock is moving higher, what is the volume like? So is it moving higher on high volume? And at the same time, when it's moving lower, we want to see what the volume is like. So is it moving lower on low volume? No, that's a worrying sign. Now this has both these examples here. Over here you can see that there are two very strong weeks of upward movement where the stock closed positive for the week, as well as volume was exceptionally high. So what this indicates is that there is a lot of institutional buying. When you see this kind of exceptionally high volume and the stock is moving higher, that's a sign that institutional investors are buying the stock. At the same time, if you look at this area, you can see several weeks the stock closed negative and the volume was also very high. So this means that there are institutional investors who are selling the stock. That's what is causing this high volume, lower price movement. So when we look at any kind of chart, we need to be very mindful about first of all what the price is doing, and as well what the volume is doing in conjunction with that price. So here, what we see here in marked in red, this is called a cow pattern. We'll discuss patterns in a little bit more detail in the later slides. So notice what happens here. So you have this pattern, the stock breaks out, it starts moving higher, then there's a slight pullback. Now it closes almost exactly near this 50-day moving average line and then bounces up from there. Bounces up, pulls back again slightly, comes somewhere close to the 50-day moving average line, again bounces up, again pulls back slightly, and this continues several times over several weeks. So what is happening here is that when institutional investors start building their position, they will do it over the course of several weeks or maybe several months. So they cannot buy into a strong position in one day. They will take a long period of time to build up a position slowly. So that's what you see here. So the stock starts moving up. That is when they are buying, and it starts consolidating for some time when institutions stop buying. And once it consolidates for a short period, the price has consolidated for some time, they start buying again. And so you can see the same thing continues for several instances. So what really happens here is that institutional investors are not allowing the stock to move lower than the 50-day moving average line. So as long as it approaches the 50-day line, they start buying more shares, and this pushes the stock higher. So this is what we call as a support level. So here in this chart, what you see is the 50-day moving average line is acting as a support level. Now what happens later? At the end of the chart, what we see is that the stock breaks below the 50-day moving average line, and notice the volumes. Volumes are very high. We mentioned that when we see the stock moving lower on very high volumes, it means that institutions are selling. So what's happening here is that the support is no longer holding. So institutions are selling their stocks, and which is why you see this big volume selling happening here. Okay, so ideally when do we want to buy stocks? In MarketSmith, we always believe that we want to buy stocks when they are on the way up. we say that the stock is only a good stock if it's moving up. So if it's moving down or if it's moving sideways, that's no use for us. We are always investing in the market in order to make profits. So we always advocate buying stocks whose charts are in the uptrend. So okay, even if you have a good, you've identified a fundamentally good stock, the reason we use charts is to time that buying decision. We want to buy it at the right time so that we get a decent amount of profit in a relatively short amount of time. Now suppose you have a chart that is a downtrend like this. It may be a really good company, but if the current sentiment is bad and it's in a downtrend, and if you buy it during this phase, you're only going to suffer losses and you will have to wait for a long period of time to get your profits. So your capital is simply sitting idle, so to speak. The same story happens here. If a chart is moving sideways, and even if it's a really nice company and you buy it, your capital is just sitting idle. So what we would advocate is always buy on the way up. And also, we cannot just blindly buy anywhere on the way up. We want to identify the right buy point so that the probability of the stock moving even higher is higher. So we want to buy in such a point such that the probability is in our favor, so that the chances are higher that the stock is going to move up. So how do we identify that? So to identify that, we look at a few chart patterns in the following slides. Okay, so we'll be looking at 3 patterns in this particular session. So here is what is called a cup with handle. We'll go over the details of what is a cup with handle in more detail in the coming slides. So what we term as the buy point is when it breaks out of this pattern, or when it breaks above what is called the pivot price of that pattern. Again, we'll talk about pivot prices in a little bit more detail. I just want to tell you why it's so important to buy at the right time. So as the stock breaks out of this pattern, you can see there is an immediate momentum. So if you had bought here, you would not be wasting any time at all. So your capital would not be sitting idle. So you bought the stock and it immediately starts moving higher. You can get some profits and you can get out when the stock starts consolidating again. So the point of all these patterns is to reduce your risk. And how do we reduce our risk? Is by maximizing the probability of the stock moving higher at the time that we buy. So how do you find stocks using patterns? So we look at history. So here at MarketSmith, we looked at historical greatest winners. After doing a study about stocks that had the biggest gains in the market, and we looked at how this chart of that particular stock looked before it made its big run. So before the stock made a big run, what was the chart looking like? What kind of pattern was the chart making? So after doing this kind of study, we find that there are a few patterns that keep repeating for the biggest winners. So which is why we emphasize on these particular chart patterns, and which is why we believe that if you buy when the stock breaks out of these patterns, the chances are that you will have a winner in your hands. So of course, be patient. Don't buy just because the stock is moving up, because it can as well start consolidating at that time. You never know when the consolidation is going to start. So this is why we say that the buy point has to be very, very right. You have to buy at a very precise time. Okay, so we'll go over some of these patterns in more detail. We'll talk about their characteristics and so on.
Okay, so we'll begin with our first pattern, which is cup with handle. So we'll be discussing 3 patterns here: cup with handle, flat base, and a double bottom base. So basically we'll be taking you through how it looks like, what are its properties, what exactly is happening in the chart, and then we'll try to give you some lifetime examples and show you these patterns forming over there. So let's start with the first pattern, which is cup with handle. So this is one of the most common and the most profitable pattern which is found in the history of stocks. So whenever you see a stock, multi-bagger type of a stock, which has gained about 50%, 100%, or even more, so it is more likely that the first base it would have made before its big run would be cup and handle. So this is how a cup with handle looks like. It would look like a teacup when you view it from the side. So now let's get into the details. These are the characteristics of any cup with handle pattern. So a stock should be having a prior uptrend of 30%. That is to say, the stock should be in rally before it actually consolidates and forms a pattern. So this is the prior uptrend of about 30%, more than 30% we'll say. Then after reaching the peak, the stock will actually consolidate and the base depth will be 20 to 30%. Depth is nothing but the consolidation that the stock observes over a period of time. The length of the base should be more than 7 weeks. That is, a stock with handle pattern should last for more than 7 weeks. A stock should have enough time to consolidate and form a pattern. This is the handle that we see, and the handle is 12 to 15% of depth. So this is the correction that you see. So correction should be not more than 15%. Sometimes in bear markets or several severe bear markets, it can go up to 33%. But in normal markets, the depth is about 12 to 15%. This handle should be forming in the upper half of the pattern. Let's say this is your pattern and you divide it into 2 parts. So this handle should be forming in the upper half. And now when the stock actually, this is the previous resistance level. Whatever you see here, this red line, this is the resistance level. So whenever a stock is able to come out of this resistance level or pull above this resistance level with good volumes, that is actually where we buy, and that is called as a buy point. So this was just the characteristics. Now let's exactly see what is happening in the stock. That was just technical terms. Now we'll see, try to understand as a layman that what exactly is happening, why is the stock moving up, why is it coming down, and why is it breaking out. So this is the prior uptrend. So this is where the investors or the big institutional investors will start buying. So after it has advanced some 20-25%, there will be news, this stock will be known by all the investors. So now even some retail investors or also small investors, they'll also start investing in the stock. Now, obviously the stock will not go up forever. So this is where the stock peaks. And now, when the stock peaks, the big investors who bought somewhere here, they will start booking the profits. And you see, this is all nothing but the profit booking. So all the big investors who bought somewhere here, they are taking their profits and coming out of their positions. So now here, the bottom is when there's no more selling pressure in the stock. So all the selling and all the profit booking has happened. Now after all the profit booking is over, these big investors will start reinvesting and with small positions. So this is how the stock will start advancing upwards now. Now here what will happen is all the late investors who bought here, they will kind of dream, okay fine, now I'm able to reach my break-even point and I will get an opportunity to sell my profits or to sell my positions near my break-even point, even with the minor loss or whatever, but at least the stock is advancing and it will reach my break-even point. Now the stock reaches here, but what happens here is all these weak investors which bought late here, they start selling their shares near their break-even point or maybe with minor losses. So this is why the handle of the curve forms. So now when this handle forms, all the weak investors have been shaken out. Now when all the kind of selling that had to happen had been taken care of, this is where the big investors would start pushing in their money once again. They started buying here, now again they'll resume their upward journey. Now when the volume is big enough for the stock to cross this resistance level, that is when we'll buy the stock, and that is called as the buy point or the pivot level. Any questions so far before I take up a live example? Okay, seems like there's no questions, so we'll take up a few live examples here. This is the weekly chart of Pfizer. So here we see, this is the cup and this is the handle that the stock has made, right? So we can see the prior up move of about 34%, and then we can see the stock actually peaked and did some kind of consolidation here. Now when the selling or the profit booking happened, the investors came in and started buying. You can see the volume bar here. So the big investors started buying. So this price goes up and hits the resistance level. Now here all the late investors, they start selling their shares. That can be seen from the low volumes. You can see below average volumes. So all the weak investors, they're getting actually out of the stock, which actually bought late. So now we'll wait for the big investors to come in and cross this resistance level. So they have crossed this resistance level on huge volumes. You can see this is 1.7 times the average volume. This is the average line and the volumes are way above it. So this is actually a buy point, which is also known as pivot point. So this is when we actually buy our stocks. So this is a weekly chart. Let's have a closer look on a daily volume with a bigger chart. So this is the cup with handle pattern in the Pfizer cup on a daily chart. So now we can see more clearly how the stock actually performed. This is the prior uptrend, which was about 34%, and after the stock peak, this is where the profit booking happened, and the stock has actually consolidated and tumbled down. Now, here the buying has started again. You see a big volume day bar here. So now big investors are again taking their positions bit by bit. Now stock reaches here. Here what happens is people who bought in late here, somewhere here, they are close to their break-even points. So they don't want to wait any longer, and they start selling their positions. And you can see the volumes here, they are pretty low. So this indicates that the small investors are actually doing all the selling part. Now once again, after all the selling has been done, big investors come in with their big fund and they start investing. And you can see this with the rising volumes here, all this while. So whenever the stock crosses this resistance level, which was the peak of this handle, that becomes a pivot level. So now when the stock reaches this level on above average volumes, at least 50% higher than the average volumes, this is when we advise people to buy. So this is where we take our positions. So I'm sure you would like to know what happened after we bought. So this is what happened after we bought. The stock gained 102% in just 66 weeks after our buy point. This was a buy point, and see how the stock actually went down. So this was one example. I'd like to take another example. So this is the example of Borosil Glassworks. Again, this is a daily chart. Okay, so this is the prior uptrend of the stock, which should be about 30%. This is how the stock formed a cup and the handle. So now I'm sure you are understanding the cup, how the cup forms, and this is more clear with the handle. Here if you see with the low volumes how the handle is formed. And now on this breakout, whenever the stock is able to cross this pivot point with huge volume, check out the volumes that have come here. This big light you see, this is the volume bar, and check out this big volume. So whenever the stock crosses this resistance level on such a big volume, that becomes a buy point. So we bought somewhere here, and stock gained about, shot up by 78% in less than a month. So be aware, whenever the stock pulls back after you buy, you shouldn't actually be afraid. The stock will actually resume its upward journey, and if you're bought at a buy point and the stock doesn't correct by more than 8%, it's okay to hold the positions.
I had a query actually.
Yes, please.
The thing that you're saying, that if we couldn't, embark on the journey of the uptrend initially, we should wait for the cup and handles formation to happen, and then again at the buy point we should buy it if in the initial stages we didn't buy it when the institutional investors were doing so, right?
Exactly. We should wait for this pattern to form, because that kind of confirms that the stock has consolidated enough and now it's ready to take another leg of its upward journey. Whenever the stock is going up, you really don't know how far it will go up, right? So that is not advisable to enter in the mid rally, because here, as we see, if you would have entered somewhere here, let's say, because the big investors were buying and the stock comes into news, retail investors usually get to know little later, right? So let's say if you would have bought somewhere here, if you would have bought somewhere here, you would have been very late, right? You might have enjoyed just this part of rally. So this is not worth it. So you have to wait for the consolidation. Whenever the big rally happens, please wait for the consolidation. That gives stocks it shakes out all the weak holders. Whatever the stock, if some people are trading, if there are some weak investors or the short-term traders, they actually leave the stock during all this while. And all the people who have built positions here, big investors, they'll also like to take profit somewhere down the line. So it's always advisable when this kind of consolidation happens, that is very healthy for the stock, shaking out all the weak investors. So when it breaks out of that pattern, that gives you the optimum returns in the shortest time possible.
Okay, so if the stock has good fundamentals, we can more often than not find these patterns, because taking the example of Just Dial, it's moving up quite fast in the just past 2 weeks. So the uptrend is confirmed there, but the move has already given 35% over returns.
Correct.
So we should wait for the consolidation.
You should wait for the consolidation to happen, because you never know how far the stock will actually go up.
Okay, thank you.
Yeah, you're welcome. Any other questions, please?
But for for traders, those who are watching daily, what should they do in this
Sorry, not audible. Can you please be a little louder? Maybe you can type your question because we're not able to hear you.
Okay.
I have a question.
Yes.
Take the case of capital first, okay?
Okay.
And it has broken out today with huge volumes, okay?
Okay.
But it is still below your pivot point. What would a trader observing this stock do? It has formed the cup and the handle, it appears.
Okay.
If
it is formed the cup and handle. Okay, so actually whenever you feel like the stock has actually formed a pattern, it will be automatically recognized by our app and the web version. So you really don't have to worry about that part. So if it is actually showing a cup and handle pattern there, so it's a confirmed base. So now we'll wait for the stock to actually close above the pivot level that you would be seeing there.
No, it's closed today above, no, it's not closed above the pivot level, right?
Exactly. So we'll wait for it. Exactly. So let it close on above the pivot level with huge volumes. The volume should be above the average volume. So in the past 50 days, at least about 50% higher than the average volume. So when that happens on the closing basis, please go ahead and buy it, provided it's meeting all the fundamental criteria.
Okay, because today it's closed above 120% volume. So one has to wait for a day or two more.
Yes, let it close above the pivot level. Okay. Because that is the resistance level that the actually stock is facing. So whenever it crosses that price, it should actually, it confirms the uptrend in the stock. Let it cross that resistance level.
Do we generally see a Marubozu formation during a breakout?
Sorry?
Do we generally see a Marubozu formation during a breakout? A single day pattern of Marubozu?
What we typically look for is just, we want to see the stocks just closing above that pivot price. That's all the criteria that we see actually. We just want volumes to be high and we want it to close above that pivot price. That's all that we look for.
Okay, fine.
Okay, any further questions? Okay, so we'll move to our next pattern, that is double bottom pattern.
Okay, so we talked about cup with handle. Cup with handle is generally a very common pattern. This is also somewhat common, but you may not see this as often as a cup with handle. Now this is called a double bottom. Now the reason it's called that is because it actually has two bottoms. It looks like a W. So you can see this W shape happens. It may actually form a handle. We'll talk about that in the future slides. Okay, so the characteristics of a double bottom. Again, prior uptrend needs to be there. When you're talking about any kind of pattern, you always want there to be some kind of prior uptrend. So it is a stock that institutions have been buying before. So that's what this prior uptrend shows. A prior uptrend of at least 30% is what we look for. Okay, and just like a cup, it hits this peak and it starts correcting. So it starts correcting, and this depth, the depth of this base, which is the distance between this peak and this second bottom over here, we want that depth to be not more than 40%. So in a healthy consolidation, a healthy double bottom formation, this kind of depth, you will not find a huge depth. So when the stock corrects, it should not ideally correct more than 40%. So after this first downward leg, we have the second upward leg, and it forms a peak. Now this peak is going to be lower than the initial peak, and this peak is the final pivot price. This is the key resistance level that we look for. Again, it's just like we said that for a cup with handle, we want the handle to be somewhere in the upper half of the base. In the same way, we want this second peak to form in the upper half of this entire base. So out of this total length, we want this peak to somewhere happen near the upper half. And after that, you have the second downward leg. And it's really important that we want the second downward leg to undercut the first downward leg. So we talked about the shakeout of weak investors. It's the same concept here. So that's why we want to see that the second leg is a little lower than the first leg. And then it starts another upward journey. And when it does start the second upward journey and it manages to move above this resistance level, or what we call the pivot price, that's our buy point. And again, we want it to close above this on very strong volumes. And of course, base length is also important for any type of base that we're talking about. In this case, we want the length to be at least 7 weeks long. So we want a decent period of consolidation and not a very quick consolidation. Okay, so what's happening? We looked at the characteristics of a double bottom. What's really happening when this kind of pattern forms? Okay, there is a prior uptrend. Prior uptrend is when institutions are buying the stock, but this is typically when everybody knows about it. So when everybody knows about it, there are not going to be enough of new buyers that are going to push the stock higher. That's why the stock consolidates in the first place. So it has rallied for some time. It's either become overextended or the market starts correcting. That's when you'll start seeing all these kinds of patterns form. So the first downward correction that we see here, the first leg. So this is when investors start taking profits. It may be because overall market is starting to weaken. It may be because stock has had a healthy run already. And basically what's happening here is profit booking. Big investors are getting out and they're booking their profits. So what happens here is the people who bought late, somewhere in this upward leg of the journey, they're seeing this kind of correction and they're getting really worried. So they're getting frustrated by their losses. It finally hits a bottom here and the stock starts to rally again. So it will start rallying again, and once it goes up by some amount, all these people who bought late over here, who were frustrated by this correction, they're going to get relief thinking, okay, I'm getting some of my capital back. So they will start selling sometime during this rally, which is why you see this peak here. Now when the small investors start selling, they are selling so that they don't want to suffer this kind of correction again. They're basically selling out of fear. So they start selling, and that's when the second leg of the correction starts. So now this second leg of the correction, we mentioned that it needs to undercut the first leg. That's because we want that shakeout to happen. We want the people who, or everybody who bought late, they start through this kind of correction. They might have sat through this initial rally, and those who did not book profits in this rally, and when it starts moving lower again, they're going to start getting really worried, especially when it undercuts this low. So this is really important. When it undercuts the prior low, that's when you're really sure that all the weak hands have gotten out, and there are only big investors holding stock at this point. So once it has undercut that low and it starts moving up again, this is when the big investors are slowly starting to buy their shares again. So if they were buying earlier, it has gone through some consolidation phase. Maybe they think the price is right, or maybe the market has started performing better. That's when the big investors will start buying their stocks, buying into this position again. It will start moving higher, and you need to watch this. Is the peak of the middle of the W, this peak in the second leg of the rally. This is really important. This is what we call the pivot price for this particular pattern, and we want the stock to move above this resistance level. Now that is when the probability is in our favor. Once it's able to break above this resistance level, that's when we say that it's more likely that it's going to move higher in a short period of time, and this is when we want to buy. So again, we want to see the stock close above this particular level, which is the peak of the middle of the W that you see, and we want this breakout to happen on very strong volume. Okay, a few examples of a double bottom. Okay, so this is a weekly chart for Capital Trust. Again, you see there's a prior uptrend here. People have been buying the stock. It's a good company. Institutions have faith in this. They have been buying it for some time, and then it starts correcting. It starts correcting. It forms a bottom. It starts rallying again, Again, notice that it's recovered more than half of its losses. So what that means is that this is in this the midpoint of the W is happening above, the midpoint of the overall base. Similar to, like we said, the handle has to be up in the second upper half of the cup. Similarly, this peak will be somewhere in the upper half of this overall base. So it rallies for some time, starts correcting again. So starts correcting, and again it undercuts the prior low. So this was the prior low. It undercuts that low and goes even lower than that low. So this is where the shakeout happens. This is where all the small investors are getting out. And then it starts rallying again. So this is the uptrend that we want to watch. So we are watching the stock here. We are watching how it behaves as it reaches near the pivot price. So as it reaches the pivot price, we want to see it cross above that level on very high volume. So that's what we see here. Where it moves above the pivot price, that breakout happens on above average volumes. And then there's a sustained rally, it goes higher from there. So we take a closer look at this with the daily chart. So here it is. Maybe it's a little bit more clear here. So here's the first leg of the correction. The first attempt to rally. Here's the midpoint of the W. Again, notice that it's recovered more than half of its initial losses. This is the second leg of the correction. It starts correcting once more. And again, this low, the low in the second trend, the second leg of this correction is lower than this first leg. And then it starts rallying again. So notice here, as it starts rallying again, there's a big spike in volume. Once it hits this bottom, there's a big spike in volume. And slowly, you can see towards the end of the pattern, volume starts picking up. So upside volume is starting to come in slowly. So upside volume starts here, stock continues to move higher. And as it continues to move higher, when you reach towards the end of the pattern, you see that volumes are much higher. So again, this is what we talked about initially. When you see the stock moving higher, we want volumes to be good. We want the stock to move higher on strong volumes. And when we see the stock moving lower, we want that to happen on lower volumes. And if you look at this very bottom here, at the very bottom, the guys who are selling are all the small holders. So this kind of selling you see here is mostly done by retail investors who are getting out because of fear. And finally, the key point. So here's your key pivot point, the mid peak of this W. So that's your key resistance level that we need to watch. We'll be watching this throughout this rally leg, and as soon as it closes above that level on strong volumes. Again, notice that as it crosses above the pivot price, volumes are very healthy and very good. So that's when we want to enter the stock. So we want to enter when volume is strong, which means we are entering when the big investors are buying the stock, which means that as they keep buying it, they are likely to push the stock higher, which means that we will get our profits quicker. So here's what happened after that breakout. This was our buy point, again breaking out on very strong volumes. 80% gain in 32 weeks. So this is what we look for ideally. We want to have this kind of rally, and we want to hold the stock through this kind of rally, which means we are making very efficient use of our capital here. We are not buying the stock while it's consolidating. We are buying it just as it breaks out, just as it starts its uptrend. Okay, here's another example. This is CAT, another double bottom base. So there is a prior uptrend. Stock has been moving up for some time. It starts consolidating. It makes a low. Once it makes a low, it starts rallying again for some time. It starts rallying. It recovers more than half of its initial losses. It makes a peak here again. So this is your pivot price. This is the peak, and then it starts correcting. So it starts correcting. It makes a low that is even lower than prior low. So there's a shakeout here, very clear shakeout. And the stock starts rallying again. Again, notice that once the stock is moving up in the second leg of this journey, you can start to see the upside volume slowly starting to come in. So it keeps increasing as the stock keeps moving higher, and finally when it breaks out, it happens on very strong volume. So here's the daily chart. Again, let's take a closer look at this. So there is a prior uptrend as always. The first leg of the correction, the first rally attempt, it hits a peak, it starts correcting again, and then it starts rallying for the second time. And here's what we see. As you see the stock moving up here, You see that volumes are very good. So this is when institutional investors are starting to buy this again. Finally breaks out, again it breaks out on very strong volume. So one fine day it breaks out, it closes near the day's high, and volume is very strong. This is ideally what we like to see in a breakout. And then it moves higher from there. So we hit a 25% gain in a very short period of time, which you can see by this flag here. So here's what happened. This was the double bottom base that we looked at earlier. This was the breakout, and very quickly we got a 37% gain in just a span of 9 weeks. So we have a gain and it starts consolidating again. So we have a gain in a short period of time, and then it starts consolidating. So this is how we, if we were to trade CAT, this is how we would suggest that you trade this. You buy it at the breakout, you get some amount of profit, then you start noticing that it's starting to consolidate again. So once you start seeing that it's going to consolidate, that's when we'll get out, and when will we enter again? We'll enter it at the next breakout. So it's making another double base here. When it breaks out of this double base, that's when we'll enter it again. So we'll talk about selling and how to recognize when the stock is starting to consolidate in the later sessions. But I just wanted to give you an idea about how you would play the same stock, buy at the right time, sell at the right time, and get your maximum profits in the minimum amount of time. Okay, so here's another base pattern. This is the third one.
I actually had a query about the last one.
Yeah.
So I was asking, seeing that the companies that you're talking about were quite good and publicly known, but there might be companies which might be fundamentally strong, but not quite known, so the volumes are quite low in thousands. So is it not recommended to buy into such stocks even though you know that the pattern formation is being done and it might break out?
We always try to look at those kind of stocks which have decent amount of volumes. The reason is that we want to buy stocks that institutions are familiar with. So those stocks that institutions have already researched and they are comfortable buying. So these are the kind of quality names that we look for. So that will be reflected by the volume, and as well as how many funds do you see holding that stock. We want a stock that institutions are confident in holding. The reason we say that is because if you have a stock which there are no institutional investors holding it, if it starts correcting, it can be a very severe correction, and you can really get trapped in those kind of stocks. But whereas if you have an institutional quality name, if it corrects too much, there will always be those people who will say that now the price is right, I'm going to add more to my position. So that will ensure that even if there is a kind of correction, it's not going to be a very severe correction.
Okay, that's helpful. Thank you.
Okay, so moving on to our next pattern. This is called a flat base. This is a little bit more uncommon than the first two patterns, and mostly this happens after a cup with handle or a double bottom. So the stock might break out of a cup with handle or a double bottom pattern, and then it might rally for some time, and then it might form a flat base somewhere down the line. So again, it's a kind of smaller base. Here, the time frame that we look for is a minimum of 5 weeks as opposed to a minimum of 7 weeks for the prior patterns that we talked about. Let's go over some of the characteristics. As always, prior uptrend is really important. We want that stock where institutions have been buying earlier, and we want to be sure that yes, people have been comfortable buying the stock in the past. Again, the base length, this is a shorter base. It can be 5 weeks long, but not less than that. But ideally something at least 5 weeks or more than that is what we look for in a flat base. And the base depth here is going to be quite small. The depth that we talked about for cup with handle and double bottom, those were much bigger than this. But this base is going to be quite small. It's going to be a small base both in terms of length as well as in terms of depth. So the kind of pullback that you see in the middle of this base is not going to be that severe. Somewhere less than 15% ideally. And again, the buy point is quite easy to spot here. It is simply the peak. So throughout this base, the stock will be making peaks and coming back. Again, making peaks and coming back. So that peak is our buy point, and we want to buy as it closes above this peak. And as always, we look for strong volumes. We want to buy when it closes above the pivot on strong volumes. Okay, so what's happening in a flat base? There is of course a prior uptrend. So this is a stock that has been rallying for some time. Of course, no stock goes up forever. It will rally for some time and it will take a break and it will consolidate for some time. And so it's a kind of sideways trading that we see. So what happens is that when the stock trades sideways, it has been rallying and the people might have bought it during that rally. There will be investors who will start to see that it's been trading sideways for a few weeks, 2 weeks, 3 weeks. They will lose their patience and they will get out of the stock thinking that the rally is over. But this is when institutions will be slowly building up their positions through this flat base pattern. And finally, when it breaks out is when institutions are really starting to build up their positions, high volume up moves are happening, and that's when we finally enter the stock. Okay, so here's an example of a flat base. So there was a prior uptrend here. It made a prior uptrend. It took a break for some time. So notice that this base it's really quite small. It's not that deep. So the depth here is somewhere close to 15-16%, not more than that. It consolidates for some time. Notice that this is a lot shorter than the other bases that we talked about. So it's more than 5 weeks long. That's what we want to see. But it's a small base. So it breaks out over here on above average volumes. So as it breaks out, you see that volumes are starting to pick up. So here is a little bit more detailed view. This is a daily chart example of that. So here's your correction. This correction is it's not going to be not that high. Again, less than 50%. So it keeps making peaks and it keeps pulling back throughout this flat base pattern. And again, as we talked about earlier, as the stock pulls back, we want to see volumes dry up. So whenever the stock is moving lower, we want it to happen on low volumes. And when it's moving higher, we want that to happen on high volumes. So what's really happening here? It pulls back, falls below the 50 DMA. Notice that as it retakes its 50 DMA, that happens on very strong volume. So the move above the 50 DMA happens on very strong volume, but the slight consolidation that happens after that happens on very low volume, which is what we want to see. Again, when it moves above the 50 DMA, it's happening on high volume, whereas this consolidation was on low volume. Now we don't buy it as it breaks out of the 50 DMA because we are not yet sure whether the momentum is going to continue. But again, this is a healthy sign that we want to see. So as it is moving down slowly, volumes are drying up. And there are, in the middle of the base, there are big up moves when it is breaking above these resistance levels on high volumes. And here is the breakout that we want to look for. So it breaks above the peak of this base on high volume. It closes above that pivot price, and this is where we would buy. So here is Eicher Motors. We mentioned that the flat base will generally happen after a cup formation. So here you see a cup formation. It makes a cup, it breaks out, it rallies for some time. Suppose you missed the stock, you didn't buy it at this time. So it's not going to rally forever. So it will take a break and it will consolidate. So that's what's happening here. It took a break and it made a kind of flat base pattern, and it broke out again, and that's when we'll enter the stock again, and then it continued its rally. And if you notice, it continued its rally. There are even smaller flat bases within this rally. So it rallies for some time, takes a break for a few weeks, again breaks out. So there are multiple entry points. So even if you miss the stock earlier, you will get an entry point in the future when it makes a base and it breaks out for the second time. Okay, so here's the same thing in the daily chart. Again, there's a prior uptrend. We see this cup with handle was there. It broke out. It moved higher. There was a prior uptrend. It trades in a tight range, so there is not much of depth to this base. So it's a kind of tight trading pattern. So as the stock moves lower within this base, it's moving lower on low volumes. And while it's recovering, it's gone low on low volumes here. And as it hits this low and it recovers, it happens on high volume. Once again, we don't buy it here. this is not the time that we would ideally buy the stock, because we are not sure whether this kind of momentum can continue. How can we be sure? That's only when this breakout happens. So once the stock breaks above this prior high on high volumes, that's when we see that the probability of it moving higher is in our favor. So this is our buy point, and this is the breakout, high volume breakout that we see, and this is where we will be buying the stock. Okay, so we went through 3 of our base patterns here. We talked about couple handles. We talked about the double bottom. We talked about the flat base as well. Remember that if you see a stock in a rally and you think you've missed it, don't just go ahead and buy it in the middle of that uptrend. Always wait for some consolidation to happen, because remember, no stock is going to rally forever. It is going to take a break at some point, and you will get an entry point in the future. So keep watching that stock. Watch for a base to form. When that base forms, you should be ready. And when you start seeing the stock, for example, in the double bottom, the second leg of the uptrend, so you should keep your eye on that stock during that time. As soon as it closes above pivot, you should enter it. So that's how you use basis to time your buying decisions, and that's how you use basis to make sure that the probability is in your favor. So if you have any questions at this point, please go ahead. Okay, looks like we don't have any questions. So
I actually had a query.
go ahead.
Yeah, so I wanted to ask is how do we know that what is the perfect price that the stock has reached and we should sell it? Like, what is the confirmed uptrend and how much will it rally up before consolidating, and that is the point that we should sell it. Like for ICA Motors, you showed that over a period of a year or two it can continue uptrend, whereas in other stocks it starts consolidating after a price point. So how do we know when is the right time to sell off now?
So ideally what we say is that if you have bought it at the right time, you need to be booking your profits at somewhere around 20 to 25%. Now suppose that the stock has rallied really strongly, it's gone up more than 25% in a span of less than 3 weeks, right? Yeah, in a span of less than 3 weeks. So in that case we'll say yes, it looks really strong at that point, keep holding it for as long as you can. You might even get even more gains out of it. But generally we say that book your profits at 20 to 25% gain. Of course, we'll have another session in the future. So we'll have a session about how to book your profits and when to spot weakness in a chart and when you should be getting out. And we'll talk about selling later on in future sessions. This was just about timing your buy decisions, but just to put it in a short way, we ideally look for 25 to 30% gains, and that's when we say you should be booking your profits. But if it's really strong and it's gone up more than that in less than 3 weeks, then it's a good idea to keep holding it and to see what kind of gains you can get.
Okay, thanks, Anna.
So before we wrap up, do we have any more questions? Okay, seems like there are no more questions. So whatever we have discussed today, that is available on our app also. So I'm not sure how many of you have actually gone through the app. So the app will tell you about the market conditions, whether the markets are doing good, doing bad, they are in rally phase or they're correcting. Then whatever stocks, quality stocks that we talked about today, if they're breaking out of a patterns that we discussed today, so then we show our recommendations on the app as well. And then on the app you can also find our weekly articles that will educate investors about our canceling methodology and how to invest. So these are the uses that you can have if you download the app. Then we have some free videos on YouTube as well about app, about our canceling methodology and general investing. So if you want to learn more about it, please get on the app and also follow us on YouTube, Twitter, Facebook, everywhere. So we post articles there, we post our suggestions there, and we also educate investors. And also, in case you want to learn more on canceling methodology, then we have our monthly paid workshops. So you can enroll yourselves for that also. So that's all for today, guys. Have a lovely day.
One small question. Do you have an app for iOS?
The app on
that will be
iOS is
launching
currently.
soon.
Yeah, we'll be launching it in a short while. We are actually developing it, but the website that we have is responsive, and actually you can open it in the iPhone, etc. as well. or in your iPad as well, and the charts and
No,
other.
that I have checked. Yes, that is.
Okay.
That is. Thank you.
Sure, that'd be great. Thank you.
Okay, thank you guys very much. Bye-bye.